Once upon a time.
Oh, I want to tell it. Me too.
Okay, we'll all tell it.
Wonderful. You start.
I was a girl in the village doing alright, and I became a princess overnight.
Now I gotta figure out how to do it right. So much to learn and see.
Up in the castle with my new family, and a school that's just for royalty.
A whole enchanted world is waiting for me. I'm so excited to be.
I'm finding out what being royal's all about. Making my way, it's an adventure every day.
It's gonna be my time to show them all that I'm Sophia Duffer.
Good morning, everyone. The title of our report is The Mathematics of Finance, with the theme of Mathematics of Finance can help you shape your financial future. And our objectives are to be able to understand what is simple and compound interest, and to be able to put into life how to do simple and compound interest. Financial mathematics is the application of mathematical methods to financial problems. Equivalent names sometimes used are quantitative finance, financial engineering, mathematical finance, and computational finance. It draws on tools from probability, statistics, stochastic processes, and economic theory. Traditionally, investment banks, corporate treasuries, and regulatory agencies apply the methods of financial mathematics to such problems as derivative securities valuation, portfolio structuring, risk management, and scenario simulation. Industries that rely on commodities like energy manufacturing also use financial mathematics. Quantitative analysis has brought efficiency and rigor to financial markets and to the investment processes, and is becoming increasingly important in regulatory concerns. I'm not ready to be a princess. I don't know what it takes. I only know about simple interest and compound interest. Simple interest is interest calculated on the principal portion of a loan or the original contribution to a savings account. Simple interest does not compound, meaning that an account holder will only gain interest on the principal, and a borrower will never have to pay interest on the interest already accrued. Simple interest is calculated using the following formula. SI is equal to P times R times T, where P stands for principal, R is equal to rate of interest, and T is time period. Here the rate is given in percentage is written as R over 100, and the principal is the sum of money that remains constant for every year in the case of simple interest. Simple interest formula is one of the methods of calculating the interest on a certain amount. First, it is important to recall the concept of interest and ways to calculate it. When you borrow money from a bank, there is an extra amount to be along with the amount you borrowed. That extra money that you pay is called interest. Some money lenders and financial institutions also charge this interest for the money borrowed. Here is one of the examples. Calculate the simple interest if the principal amount is Rs 2000, the time period is 1 year, and the rate is 10%. Also, calculate the total amount at the end of 1 year. So here is the solution. According to the formula of simple interest, we have SI or simple interest is equal to P times T times R over 100. So from the above values, SI is equal to 2000 times 1 times 10 over 100. So from the above values, SI is equal to 2000 times 1 times 10 over 100 is equal to 20,000 over 10. So the simple interest at the end of 1 year will be Rs 200. For the amount after 1 year, A is equal to P plus SI, so A is equal to 2000 plus 200 is equal to 2200. Hence, the total amount at the end of the given tenure or year will be Rs 2200. Let's move forward to compound interest. Compound interest or compounding interest is the interest on a loan or deposit calculated based on both the initial principal and the accumulated interest from previous periods. Thought to have originated in 17th century in Italy, compound interest can be thought of interest on interest and will make a sum grow at a faster rate than simple interest, which is calculated only on the principal amount. The rate of which compound interest accrues depends on the frequency of compounding, such that the higher the number of compounding periods, the greater the compound interest. So, how compound interest works? Compound interest is calculated by multiplying the initial principal amount by 1 plus the annual interest rate raised to the number of compound periods minus 1. The total initial amount of the loan is then subtracted from the resulting value. The formula for calculating the amount of compound interest is as follows. Compound interest is equal to total amount of principal and interest in future or future value less principal amount at present or present value, where P stands for principal, I, nominal annual interest rate in percentage terms, and number of compounding periods. Example, an investment earns 3% compounded monthly. Find the value of an initial investment of $5,000 after 6 years. So, the solution. Determine what values are given and what values you need to find. Earns 3% compounded monthly, the rate is equal to 0.03, and the number of times compounded each year is N is equal to 12. Initial investment of $5,000, the initial amount is the principal, P is equal to 5,000. 6 years, the time is 6. You're trying to find A, the future value, or the value after 6 years. Now, apply the formula with the known values. A is equal to P, close and open parenthesis, 1 plus RM MP is equal to 5,000, close and open parenthesis, 1 plus 0.012, 12 times 6 is equal to 5,984.74. So, the value after 6 years will be $5,984.74. Important! Be careful about rounding within the formula. You should do as much work as possible in your calculator and not round until the very end. Otherwise, your answer may be off of a few dollars. Amber, can you please teach me about credit cards and consumer loan, please?
Sure, stepsister. It's time for me to shine. Hi everyone, this is Princess Amber. Credit card is a plastic card that contains information and authorizes the person whose name appears on it to charge purchases or services to his or her account for which he or she will be later billed. And there are two types of credit cards, the bank cards and the travel and entertainment cards. When a customer uses a credit card to make a purchase, the customer is actually receiving a loan. Typically, there is an added cost to the consumer on credit in the form of an annual fee and or interest charges on purchase. A finance charge is an amount paid in excess of the cash price and is the cost to the customer for the use of credit card. Most credit card companies issue monthly bills. The due date on the bill is usually 1 month after the billing date. The bill is prepared and sent to the customer. If the bill is paid in full by the due date, the customer pays no finance charge. If the bill is not paid in full by the due date, a finance charge is added to the next bill. The most common method of determining finance charges is the average daily balance method. Interest charges are based on the credit card's average daily balance, which is calculated by dividing the sum of the total amounts owed each day of the month by the number of days in the billing period.
Oh, Amber, I'm actually waiting for Hildegard, but yeah, I think I can teach you about that. Here's what you need to know about introductory or promotional APR or annual percentage rate. A credit card company's introductory annual percentage rate is a low rate offered as an inducement to apply for the card. After the introductory period, the APR will increase. Introduction periods must last at least 6 months according to the Credit Card Act of 2009. For a limited time, introductory periods often offer cardholders a zero annual percentage rate. This special interest rate may apply to purchases, transferred balances, or both. Depending on the card, you will be charged a new interest rate after this term ends, and you will owe interest on any outstanding balance. So these special rates are offered by card issuers to entice new cardholders to begin this they offer a significant benefit. Oh, Hildegard, you're finally back.
A week is really long time to be away from my friend, and for them to be away from me. I should spill some tea about regular APR. Good morning, everyone. My name is Nina Cartagena, and today I will discuss about regular APR. What is regular APR means? Credit card's interest rate is the price you pay from borrowing money. For credit cards, the interest rates are typically stated as a yearly rate. This is called the annual percentage rate or APR. On the most cards, you can avoid paying interest on purchases if you pay your balance in full each month by the due date. How much APR is too much? A credit card APR below 10% is definitely good, but you may have to go local bank or credit union to find it. What is good? Irregular APR? A good APR for credit card is 14% and below. That is better than the average credit card APR and on a par with the rates charged by credit cards for the people with excellent credit, which tend to have a lowest regular APRs.
Hi little royals, did you guys already figured out about what cash advance and penalty APR is? If not, then let me teach you. What is cash advance APR? It is the annual percentage rate of interest that you have to pay for credit card cash advances. Just like for example, you do have 1,000 cash advance with a 24% APR. So it would look like this. $1,000 times 0.24 is equals to $240. So it simply means that your annual percentage rate of interest is $240. When you say penalty APR on the other hand, it is an increase in your interest rate when you miss a payment or a payment is being returned. It will replace your standard APR and your account will accrue interest in the same way as before but based on the new rate.
A consumer loan is a type of loan in which you take on a personal debt to pay for goods or services. In the Philippines, common types of consumer loans that are offered by banks are auto loans, motorcycle loans, and home loans. You may not be familiar with the term consumer loan, but the odds are high that you've taken out one of these loans in the past. Consumer loans are a category of lending products designed to help you finance a wide range of consumer purchases from a day-to-day shopping needs to major life events such as buying a home. The vast majority of loan products available to you fall under the umbrella of consumer loans. For this reason, it's important to understand how consumer loans work, how they can be used, and the benefits they can offer as a financial tool, as long as you don't abuse the privilege of these products. So these are the 5 common types of consumer loans. 1. Mortgage loans. These are used to finance a home or even access equity you build up in a property you already own. Auto loans. According to Experian data provided by U.S. Public Interest Research Group in 2018, 85% of new car purchases and more than half of used car purchases involve auto financing. Credit cards. Rolling credit accounts fall under the consumer loan category. Excessive spending on credit cards can put consumers in a deep financial hole, but responsible use of credit cards can improve cash flow management and even generate rewards. Personal loans. Personal loans can be broad and flexible, allowing you to afford a wide range of purchases. Student loans. Educational loans fall under the umbrella of consumer loans.